Hey, gang, welcome to another episode of Charts and Coffee. Happy Wednesday, everybody. Mm, we'll see if the market's going to release a kraken on us today or not. It's kind of interesting. I just sent out an alert to the sector secrets and mastery folks, and it really wasn't about, hey, look how the big guys are struggling per se. It's really about when we see the kind of moves, and I just want to talk about the candle because I know a lot of folks looked at yesterday's candle, looked at their P&L, and certainly, and this is inevitable, right? I've been doing this for 3 decades. It doesn't matter if it was pre-internet, post-internet, television, whatever. There's always going to be this insinuation that somebody knew something and they were already sure, or they already knew to go to cash and things like that. All right. So this morning, and I'm not an avid zero hedge reader, but I follow it on my tweet deck because there's good information there as long as you can sort of parse through the crazy stuff, but it's good stuff. And there was this particular, here, let me show it to you guys. I'm a huge Kathy Wood fan. I'm in ARC, all my cards on the table. I have FGQ, and I thought this was really interesting. This is the fund ETF that had the hottest hand last year. I mean, very, very good, really smart people, right? I don't think I need to go on with platitudes about ARC. You guys know what they're all about, and they're very good at what they do. Read the article, not with the whole, oh, look at the big guys, haha. No, look at the big guys. When we get candles that look like this on the NASDAQ, when we get candles that go beyond typical price movement ranges, so this is a 6-month historical look back that I study. This is kind of akin to maybe the idea of what institutions, hedge funds would use historical volatility to determine value at risk. I'll just use it to understand what's normal price action. We have been so beyond normal price action that what happens is, and some of you might have seen the movie Margin Call, and there's a 5 or 6 minute scene, which is probably one of the best scenes in any of these financial movies. And they describe what's happening when they're looking at their spreadsheets and realize that the algorithms that are factored in a certain amount of typical historical volatility, when that volatility is exceeded, that algorithm essentially is broken because it's assuming things can't get any worse than X. X is usually some sort of volatility calculation. And when we go beyond that, you've got '08. And that's what Margin Call was basically loosely, not even that loosely, kind of a docudrama, if you will, on the collapse of Lehman. So, when we get these anomaly type moves, you're going to see that it's tough to deal with. So part of, and the position sizing question is one that, clearly we start to look at, not just stop losses, but position sizing. I think position sizing becomes really the crux of the whole environment. And this is where it's really simple. Someone said, Rog, give me a basic position sizing premise. And this is very much, something that I picked up from, different market wizards. I think Tom Basso specifically. And that is, if all your positions were to hit their stops, this is something we talked about in market money math too. Are you anywhere near risk of ruin? That's why I'm a big fan of fixed bet size, fixed position size, not this position's larger, this position's smaller, because that somehow suggests we know where the markets are going. And if you can wake up every morning saying, I know what pitch I'm looking for, I know which one I'm going to swing at, but I have no idea what's going to be thrown at me, you are now really maturing as a trader. You can't impose your will on the market, gang. And I think the last 2 days were really a kind of a brutal but valid wake-up call for that. So I hope that sort of puts some perspective. We talked a lot yesterday about how Powell was, and today again will be the main reason for market movement. Yesterday, why do we have that wick? We can talk about oscillators and moving averages. Forget all that. What did Powell mention? They're not going to be hiking rates anytime soon. That the economy is not overheating. They're not past or even to their 2% threshold on inflation. So everything that bonds seem to have been sort of projecting, and everything that Fed fund futures seem to have been concerned about maybe September or December when we'd see a 25 basis point hike. I think that's been not eliminated, but certainly those fears have been, well, lessened. Okay. And we'll see how day 2 of Humphrey Hawkins' testimony goes. All right. So there's your quick 5-minute recap of what's going on in my head, things to kind of keep a good, healthy perspective of what's going on, and sort of a forest for the trees type mindset. All right. Let's take the first question here. Hey there, Living. Can we look at SLV? Of course. You know, gang, for as much as there's so much talk about Bitcoin, and I think a lot of you know, I'm a Bitcoin believer, right? I have a good belief in what's happening in Bitcoin as far as what the implications are, what the suggestion about Bitcoin's popularity is. I think some of it's straight up a FOMO trade too. But to me, to your point, looking at SLV, yeah, I like, look, in this environment, if you think that central banks have run amok, if you take a look at your macroeconomic sort of foregone conclusion, you say, why would I not be long silver? Why would I not be long gold? Not as a trade, not as a momentum position, but just I'd rather be long than short. It makes sense. Now, silver's going to benefit from a lot of what copper's benefiting from right now. And, you know, copper, and let me mention this as well. Copper and crude told 2 very interesting stories. And there was a great, I don't know how many of you watch Billions. I'm referencing movies and TV today, but I think there's a lot of great lessons sometimes. I don't know how many of you watch Billions, and I can't remember what season it was in, but it's when they introduced the character Taylor Mason. So Axe can't trade. Taylor's running Axe Capital, and there's an earthquake off the coast of something or other. And Axe can't communicate with the office. He sees the alert, you know, show up on his phone. And Taylor happens to be in a lot of South American commodities. I think they had sugar exposure and things like that. Brazil, I think they were specifically exposed to Brazil. And Axe would have known by looking at the earthquake, you know, this is the supposition, that he would have connected all those dots. And because Taylor was new, she was a newer trader, brilliant as she was, she just didn't connect the dots. I'll tell you, if there were dots that I could go back, and sometimes these things are true, and sometimes they're just correlations that may not prove to be true. But if there's anything that, when people ask, Rag, how do we know that tech was going to roll lower? Gang, crude oil and copper never flinched. If you take a look at the CL contract, you take a look at the HG contract, these are commodities that are rallying because we're in a reflation environment, and they never even pulled back. They never even flinched. And if I look back now, if I was looking for, in the case of a pullback, which I was not top picking, guessing at, were we going to pull back at some point? Sure. Pullbacks are inevitable. The scale of the pullback is something we cannot control and cannot predict. Okay. So when we look at which markets are going to be more susceptible to pullbacks, you know, yes, it's in hindsight, but I think this is some dots you can connect next time. Crude and copper didn't flinch. That means Dow's probably not going to flinch as much. And then in sort of falling in line with that, probably not S&P and Russell as much. So that leaves, if there's going to be more weakness, a little bit more tech exposure. Just something to think about. So if we're seeing a pullback in the broader averages, and 2 key commodities, the canary in a coal mine. And by the way, this week's issue of the Countdown Trader is about these 2 canaries in a coal mine. So you can check that out at countdowntrader.com. So when I look back and say, you know, if I were to sort of brace myself again, looking at where the market might get hit hardest, and crude and copper are moving higher, you know, think about that next time. Maybe tech's going to take it on the chin a little bit more. Not any kind of guarantee, but something to think about. So in that whole light of, well, what are the connective dots? My friend, if I think that Bitcoin is a hedge against inflation, if I think that, and in many ways a bet against sort of central banks and so forth, I think silver and gold are too, but silver is going to have some more behavior linked to copper, which is going to benefit it because real yields have not yet started to fall, which means gold is still going to be a little stuck in the mud. All right. There was a technical bounce here. We saw in GLD, this was a free video that I posted last week before we bounced. And it wasn't any kind of, it's not prescient. It was just the fact that we're coming down to a level where, hello, we're probably going to run a lot of stops from that previous low in November. So that's the difference between silver, gold, copper, but I think silver is solid for sure. All right, next up. Hey there, Line Watcher. Does a stock simply have to break the 55 EMA to break double green environment and trend? No, Line Watcher. It depends on the quality of the trend that preceded the move lower. Because remember, our double green is actually an assessment. So if I'm looking at, for example, I got a lot of questions about Tesla, right? This is what it's like when a popular honey badger of a stock, uncorrelated at the time, relative outperformer becomes a correlated stock. In other words, it's heavily weighted within the NASDAQ. It's heavily weighted within the S&P now. But so if you're wondering, when do we go? It's a good example of a strong, beautiful trend that transitioned specifically on the 11th of February to a sideways market. Not bearishness, though. And then notice when we went red, that top red arrow, you see there in my JT trend history, that top red arrow means the 8, 13, 21 combination, those three exponential moving averages have gone bearish while the wave is kind of neutral, the 34 EMA. So yellow means 8, 13, 21 are neutral and 34 is neutral. Red over yellow means 8, 13, 21 have gone bearish while the wave is still neutral. So this tells me that we have bearish sentiment and momentum, right? And you might say, well, Rog, of course we can see that. But in fairness, notice that actually changed on this indicator on the 19th, not when the market started selling off. We went bearish on 8, 13, 21 on the 19th of February. Of course, the 22nd and the 23rd are when we saw that acceleration in price. All right. Not that I'm saying this is a leading indicator, but the 8, 13, 21 were telling us something. All right. So that's where I'll tell you, have we gone double red yet? And to your question, we smashed the 55 EMA. But think about what double red would need to be. Much more established weakness, but we just broken the uptrend. But I still think it's justified to look for, say, volume identified, which is where we are right now, using maybe a slow stochastic or a ready aim fire. Some of you might like an MACD. Those of you that are in the futures room or the sector secrets mastery room know that I've got this little label that tracks a 12-26-9 MACD, a 20 period CCI, and a 21K 3D stochastic, slow stochastic. And I'll use them in different environments. The one that I'd use right now is the slow stochastic. And if we're going to start to see momentum to the upside, the MACD should pop back above the 0 line. So I use pretty pedestrian indicators. I don't get too cutesy. Even my wave and propulsion are just different ways of using exponential moving averages. Darvis, my gosh, that's a 60-year-old indicator, 60-year-old process from Nicholas Darvis. So I use pretty classic, I guess you could say old school stuff. And I don't get too cute with the settings. Keep them pretty simple. So that's what I would look for, in terms of understanding that dip versus oversold. Okay. This would be oversold. So if you have a specific symbol, Line Watcher, let me know. That way I can give you a little bit more specific price analysis. Johnson & Johnson. Hey there, Webuilt. Now, so Line Watcher, Webuilt's question kind of goes back to yours. Red grab candle, yellow over yellow. Is that a dip that's buyable? Yes. So Webuilt, I would also say, take a look at XLV, not specifically the ETF, but what's inside of it. So I would say you'd want to open up a multi, or however you like to scan through the heavily weighted stocks of a specific ETF, and I would look at some of the other names within it for possible relative outperformance. And J&J might, it might very well be it. So I'd scan through the heavily weighted stocks within the XLV. And I think you've got a relative outperformer in J&J, which means that the tide is tricky on this one, right? We saw what happened to the indices. Healthcare is going to go out with the tide in terms of S&P and Dow weighting. So Johnson & Johnson is actually showing to be a really good relative outperformer. So I'm with you on that one. Yes. Anywhere between where we are now and the 55 EMA is fine for me to build a long position. Yeah, I like it. Next up is, hang on, gang, let me grab the next question here. And good morning. Yes, gang, everybody. Kathy, hey there, Pamela. Kathy Wood buys when everyone is selling. Yeah, I'm a huge fan. I think a lot of people feel, especially when we're retail traders, that no one else is caught off guard. And when we talk about the hottest hand and probably one of the most brilliant minds on the street right now, a lot of people get caught off guard, and if there's anyone who's great at buying those pullbacks, look, gang, not everyone can dance backwards in high heels. You know what I'm saying? And she is showing her commitment, her conviction to her positions. She's lowering her cost basis in some situations, I'm sure. But what I wanted to show, again, no Schadenfreude, is we don't take delight in what they're having to do. We just realize that we're all human. And I think they had to liquidate Apple to buy Tesla. Kind of interesting. So, but I would never bet against her. And yeah, she's a dip buyer. How to buy the dip needs to be a book, right? How to buy the dip. Dip happens. Dips happen. That needs to be on a t-shirt. All right, moving on. So Marty Jean asks, what's going on with NQ? Again, I think NQ is just going out with the tide like everything else is. You guys notice that it wasn't just a few heavily weighted names and big names and high momentum names that were rolling over. I mean, after a while, even less correlated names were going out with the tide. I mean, look at cannabis. Why is cannabis lower? I mean, with what happened the last few days, wouldn't cannabis benefit? I'm only being slightly funny, or maybe not funny at all, but everything started going out. Bitcoin sold off. Cannabis sold off. So I don't know that it's limited to the NQ, but I think NQ got hit harder because the reflation trade probably benefits the Dow right now more. Again, the sort of the cues, the clues could be the two canaries in the coal mine, my crude oil, my copper, suggesting, gang, the reflation trade is alive and well. Let's get through day 2 of Jerome Powell. After Powell, whatever messaging that the Federal Reserve feels was not as clear as they would have wanted it to be, or the interpretation of his words were not what they intended, they're going to send out the cleanup crew, gang. I think Bostic's already on the schedule for Thursday. Watch for maybe Williams to pop up. There's going to be other Fed members who say, well, this is what we meant. This is what the market got wrong, et cetera, et cetera. So don't be surprised. But there's nothing that I heard in Jerome Powell's words yesterday that suggested any way that they are ready to make a shift to monetary policy before 2022. Okay. That stonks should like. All right. So thank you for the question about the NAS. All right, let's see. Grain. Yeah, so as far as the range measurements, what I use is here we go. What I use, so for those of you wondering, Rog, what about these range measurements? These are kept up to date with current price and current volatility. It's got a 6-month look back. So when I look at this type of movement, it's factoring in the higher price. It's factoring in previous volatility, not of the last week. That's why I find average true range helpful, but not inclusive of the longer historical volatility that I like to have to supplement average true range. So this is price movement range. And yes, it factors in the fact that the Dow now is a much higher. Oh, give me 1 second here. There we go. It factors in the fact that the Dow is priced higher and the swings are going to be. So that's priced in. These are the typical daily price movement ranges for the Dow. Upper end is about 600 points. So thanks for the question. Yes, that's factored into what I'm sharing with you guys, 100%. All right. Brian says Billion Rocks. It is very good. I'm actually rewatching the episode called Magical Thinking. I can't remember what season it was, but it's really, really good. Let's see what else we have here. Hey there, Gary. I mentioned that I day trade. Is there a subscription service other than the Sector Secrets? Oh, I day trade, Gary, in the futures room. I day trade in the simpler futures room. And there's a number of us in that room. So that day trade. So that's where I do most of my day trading. It's not a super active style. If I get all of 2 to 4 trades in the morning by 11:30, that's a good day for me, right? I'm picking my pitches, waiting for certain types of setups. And so it's a very, I won't call it inactive. It's just a very selective form of intraday trading that I limit to the first 2 hours of the day. All right, gang. So that is it for this Wednesday's episode of Charts and Coffee. Thank you as always for joining me. And if you have not yet checked out any of our rooms over here at Simpler Trading, please do. We have trials for many of them. And I'll see you guys tomorrow, same time, same station. Check out that issue of Countdown Trader that just came out yesterday, 2 canaries in a coal mine, explaining the importance of copper and crude. And be good to each other, gang. I'll see you tomorrow. Remember, Powell is day 2 today, so another caution day.